What's up YouTube? Dougie Chong here. Welcome to today's episode where I'm going to give a complete update on my simulated stock trading portfolio. For those of you that are new to the channel, first and foremost, hit that red subscribe button, but the simulated stock trading portfolio started late last year with about $100,000. And it is actually up about 5% now, which is crazy considering everything that is going on in the world. 5% is a pretty good return for any normal year in the stock market, let alone a year like the year we're having right now, and 5% definitely blows out the 1% or probably even less than 1% that a bank will pay you in a savings account. I post all the trades in a Discord chat. I'll leave a link in the description below. It's interesting that at the start of this portfolio, the Safe Pick or VOO index fund was outperforming all the stocks I picked. But now all the stocks are truly living up to their expectation and outperforming the index fund. So now I'll go over each of the 10 stocks I'm holding in the portfolio in a little bit of detail. 10 stocks is a pretty good number to have. It means about 10% for each stock on average, a little more if you really believe in it and it's a pretty safe stock, and a little less if it's a bit of a riskier play. First up is Apple stock, which has done extremely well. It's up about 31% since I bought it at an average trade price of $241. It is now trading at $318, so needless to say, it is a huge winner in a very short amount of time. I purchased these shares near the beginning of April, so to be up 30% in about a 2 months time is simply incredible. Recently, I heard that Apple is trying to release a new product called Apple Glass that is very similar to the Google Glass product, and we all know how that turned out for Google. It didn't turn out very well. They scrapped the project, but if any company can pull off like these digital headwear, it would be Apple. They also have a new iPhone SE coming out, which essentially is an iPhone 11 packed into the body of an iPhone 8. I personally prefer to use Android phones, but I am using an iPhone now because it was given to me by my company. But yeah, there's very little to complain about Apple products. They have very smooth, elegant design and a very easy to use UI. The only thing I don't like about it is the price. So this new SE model should certainly help consumers that want to stay in the iPhone ecosystem but are on a budget. This is a stock that I really don't see myself selling anytime soon. They have a great ecosystem, a very dedicated fan base, and should be able to print money for the foreseeable future. But would I buy more shares at $318? Probably not. I'm gonna wait until it's at least back under that $300 threshold to even begin considering buying more stocks. Alright, next on the list is ACDVF, or AC if you're on the Toronto Stock Exchange. This stock ticker symbol is for Air Canada, of course. It's currently trading for $12 when I bought it around $10, representing about an 18% gain in even less amount of time than the Apple stock. I made a video very recently on the pros and cons of Air Canada stock, and I'll leave a link to that in the description below. This stock is without a doubt a lot more risky than Apple stock because their balance sheet, business model, and market in general are all pretty shaky and uncertain right now. They have gone bankrupt in the past before, and the government is pretty reluctant to give them a bailout. Therefore, I will most definitely not be adding more shares of Air Canada stock. I won't be selling anytime soon, but I also will not be buying more. It did dip around that $9 region very recently, but I missed out on that opportunity. Third on the list is CCL, or Carnival Cruise Lines. Carnival Cruise Lines is the only stock in my portfolio that I've had to take some losses, and if it wasn't for this one bad pick, my simulated portfolio would be even higher than it already is. But this just shows that nobody can pick 100% perfectly, but by having a very well-diversified portfolio, I have minimized my losses. But even though the position is at a loss, the stock has rallied a lot as of recently, from about $10 all the way up until about $18 before settling around $17 today. The Saudi wealth fund that recently bought in at around $8 surely has made a killing, even though they probably have not sold yet. The Thinkorswim platform says I'm up about 23% on these shares. That's not exactly accurate because I did sell some at a loss. For whatever reason, the platform just treats buys and sells the same and comes up with an average trade price. But my average cost basis for Carnival Cruise Lines sits at a little bit over $20, so I'm not that far off from being break even. But the news surrounding Carnival Cruise Lines has been pretty positive as of recently. They seem to have enough cash to get around to about next year, and the cruise lines seem to be starting as early as August. Of course, this news is to be taken with a grain of salt because this timetable has been pushed out multiple times before. But essentially, people do not like being cooped up inside, and a cruise getaway seems worth the risk for a lot of young people. There is still a lot of uncertainty surrounding the stock, but since I have built my position pretty much as far as I want it to be, I will not be adding any more shares. That being said, I will also not be selling any shares. It still has a lot of potential to go way higher. In as little as a year ago, it was trading for over $40. Number 4 on the list, we have the Magical Kingdom stock, also known as Disney. Disney stock currently trades at $121.53. It is up about 30% since I bought the shares at an average price of $93. So clearly it has done extremely well. That's about a 30% gainer in about a 3-month time frame. Their business is still being hit pretty hard right now, but Disney Plus, their online TV streaming service, is their one bright spot. This stock, I would say, is a very safe bet to recover. Not quite as safe as Apple, but definitely safer than something like Carnival Cruise Lines. I also heard a rumor that NBA games might start to occur at the Disney Sports Complex. I think that would be pretty cool to watch, and I think this happens mostly because Disney owns ESPN. But that's a fabulous way to repurpose some recreational facilities that aren't being used right now. If I didn't already have such a big position in Disney stock, I might consider actually buying a little bit more. But as of now, my position stands at about $10,000 and I'm okay with that amount. Next on the list is Facebook stock, another clear winner, up about 31% from my average trade price of $174. It's currently trading close to its all-time high at $229, so clearly Facebook stock is on fire. This stock is definitely going to grow in the future. Advertising is such a big industry, and even though it's getting hit now, it's definitely going to explode in the near to short-term future. My current stake in Facebook stock sits at about $15,000, and I'm not looking to sell any of those shares anytime soon. This stock definitely has the potential to hit around that $300 or $400 mark within the next few years. To top it off, they are a technology company that is very well positioned to move to 100% remote work if need be. Number 6 is the most surprising pick of all, iRobot stock. It is up the most percentage-wise in my account, up a whopping 42%. My average trade price for iRobot stock was $51 and it currently trades at $73, and just a few days ago it was as high as $78. So to say that iRobot stock is on fire would be an understatement. And unlike Facebook and Disney, which I bought on the way down when they were getting hammered and they were almost certain to make a recovery, iRobot stocks I purchased before this whole global situation started, so it makes that increase even that much more impressive. Who would have guessed that Roombas would be extremely popular if everyone was forced to be inside all the time? I actually sold some recently at about $70 because the run-up was just too ridiculous. I couldn't believe how quickly the stock was going up, but the rest of the shares I'm not selling anytime soon or buying more. They have a phenomenal balance sheet, so I'm not too worried about them surviving in the near-term future. That brings us to number 7 of Triple M stock. It is up 6.8%, up from $148 to $158 today. This stock would have been up a lot more, but I kind of averaged up a little bit too high. But this is a company that makes face masks, they also make tape, so overall it's a very safe company and kind of balances out those riskier plays in my portfolio. As is a common theme in this video, I am not looking to buy or sell any more of Triple M stock. Number 8 on the list is the S&P 500 Index Fund VOO. This index fund is down about 5.6% from $295 down to $279 today. This index fund tracks the top 500 companies by market cap in the United States of America. And with all the furloughs, all the commotion that's going on in the world, to only be down about 5% is pretty crazy. I pretty much purchased this stock back in December of last year, or before everything started happening, pretty much at the apex, a little bit off of the apex from that all-time highs. Realistically, I should average more into this stock, but I'm gonna kind of use it as a bellwether. I'm not gonna buy or sell any more of it, and you'll see how my portfolio compares to the S&P 500. So S&P 500 right now is down about 5%, whereas my account is up about 5%, representing about a 10% difference. In the future, I might consider adding more VOO shares to kind of see how it would perform against a dollar cost averaging of the index fund, but as of now, I'm just gonna leave it how it is. Next on the list, we have the 10% loser of Wynn Resort stock. It is down from about $97 to $86 today. Of course, Wynn Resorts makes the majority of their money from hotels and from gambling, and both of these industries are pretty much shut down right now, so it's no wonder that their stock has taken a beating. There are signs that the economy is starting to open up again, but there's still a lot of risk with this company, so I'm not gonna hold it against it. I think it has the potential to really recover extremely quickly, but I'm not gonna add any more shares. And last on the list, we have Exxonmobil Stock, which is up a whopping 17% from around $39 to $46 today. This was my quick term oil play where the price of oil was sending a lot of stocks crashing. And so to be up 17% is pretty good. If it goes up to about 20 or more, I might consider selling my Exxonmobil stock. This is because I did not really build the position out as big as I wanted it to, and then the extremely long-term outlook is not very good either. Fossil fuels will not be used in the future. So that 17 to 20% short-term gainer is pretty good to just take as of now. So there we have it. That's an update of all 10 stocks in the simulated stock trading portfolio. If you have a stock that you want me to review, leave it in the comments below. It's important to note that this account was as low as about $82,000 just a few months ago, so having that mental fortitude to not sell during these low points is what separates successful traders from the rest. It's also okay to not be right 100% of the time. I've shown that with Carnival Cruise Lines, I was definitely nowhere near the bottom, but it's important to learn from your mistakes and carry on. Don't get too traumatized by big losses, but also be careful not to make the same mistake twice. That's it for this video, guys. Hope you enjoyed the portfolio update. If you enjoyed this video, don't forget to leave a like. Also, don't forget to subscribe to the channel if you have not already. Enjoy the rest of your Wednesday and see you in the next video.